Welcome to FT Markets. Oil prices remain under pressure. Even though US shale production looks to have plateaued, demand remains very good at more than 1 million barrels a day, and OPEC members are warning about the implications of investment cuts on prices. Oil is still a very weak market. Here to discuss what's happening is my commodities colleague, David Sheppard. David, we've heard this week from OPEC kingpins such as Saudi Arabia that the lack of investment by big oil companies at the moment is sort of setting us up for a price spike in future. Yet, when we look at the market, US oil prices went below $40 a barrel. Investors don't seem to be listening. What's happening? I mean, why is the price so weak at the moment? Is there one factor you can point to, or?
The market is somewhat divided, but in the short term, the biggest overriding factor is that there is just far too much oil in the world. Inventories of crude oil have ballooned in the last few months. The EIA, the International Energy Agency, came out last week and said that in the developed world, oil inventories are close to an all-time record of almost 3 billion barrels a day. Now that's a huge amount, which would take over a month of non-stop world demand with no additional production growth just to burn through that on its own. As a result, we're seeing pressure on the front of prices all the time, which is making this market very, very difficult to break out of the long-term downtrend it's been in.
Okay, so I think we can see that in the chart that we have here, the inventory levels. I mean, clearly, that gives a really good graphic illustration of the glut and the sort of overproduction there. And it's interesting as well because demand's actually been quite good this year, hasn't it? I mean, it's for 1.8 million barrels a day, give or take, depending which agency you talk to. Yet we've still seen this huge rise in inventories. I guess the question I have now is how much storage is actually left in the world?
In terms of storage, we're not yet at tank tops, at that level whereby there's just no more room for the crude or the refined products to go into. However, we are getting closer to that level. Many people think that they'll be able to burn through a lot of the oil as winter comes on and demand increases because of heating demand and other sources. But there are concerns that already the infrastructure of the world energy economy is started to be strained. We've seen in the last few weeks that the number of oil tankers at sea has started to mount. Now, this isn't necessarily floating storage as such, but what you're seeing is that ports and oil tanks, it's taking longer to get the oil into port just because of the sheer volume that there is in the world right now. That's one indication that this market remains heavily oversupplied.
So could we be heading for a situation where the price has to move even lower? I think we can show it here. US oil price, I think, sort of it's back to the sort of the low of this year, but below $40. To incentivise floating storage, given where tanker rates are at the moment, we're going to have to see probably a much lower price than that. And I noticed Goldman Sachs yesterday saying there's a possibility if onshore storage is filled up, we could go to $20 a barrel. I mean, is that a real possibility?
There's always a possibility in the short term that oil prices fall further. $20 a barrel, possibly not. Even for Goldman Sachs themselves, that's not their core thesis. They were just warning there is a possibility as opposed to what they're actually predicting right now. What we could see, however, though, is that if the front end, i.e. the prices for immediate delivery, could fall a bit further, while those further out for delivery, say in 6 or 7 months' time, they may rise slightly to allow what is known as floating storage, which means when you put the oil onto a tanker, buying it at that cheap price, selling it forward in the futures markets at the higher price here, and that lets you capture the difference between the spread as long as the cost of hiring tankers is not too high. And of course, at the moment, the cost of tankers has gone up because of the sheer amount of oil in the water.
Okay, well, if we move beyond the next 3 to 6 months and look at the slightly longer term outlook, if we bring up the next chart here, we're looking at US shale production. As you can quite clearly see there, it seems to have plateaued and is now starting to fall. So it does seem as if OPEC's strategy of letting the taps remain open and pressuring high-cost suppliers is starting to work. And we've also seen oil companies slash billions of dollars of investments this year. So are we setting ourselves up, as Mr. Naimi, the Saudi oil minister, claimed this week, for a spike in prices 1-2 years down the line?
That's where the biggest split in the market is right now. Yes, we've seen all this money come out, but also while we're seeing US shale come off, which of course in many ways has been the poster boy for the growth of this oil glut, that's coming down. But years of investments at $100+ oil from 2010 through to 2014 has also built up this backlog of projects which are still going up forward and will still continue to come onto production in the coming years. That means it's not quite clear yet whether we're actually going to see a shortage 3 or 4 years down the line, which of course trying to predict that far in advance in the oil market is anyone's game. What we could see, however, is that people have been through this cycle before. Oil, as was definitively shown in 2014, remains a boom and bust market. Of course, then, with all the investment coming out now, 5, 6 years out, could we see a price recovery? Absolutely. Could we see one sooner? Very possibly. But at this moment in time, the market is very much split. Right now, lower for longer is the mantra, but the biggest producers in OPEC are warning that if people don't invest, we could see prices shoot back up in the future.
Thank you, David. So, as we head into 2016, oil finds itself in a tug of war between those who think the price will remain lower for longer because of the supply glut and those who see a brighter future as the cutbacks we've seen this year start to feed through.